Good morning to everyone, and especially a warm welcome to Professor Wolak. It's an honor to have you here, Frank. And it's a pleasure to see you here in Barcelona, even though it's raining for several days. It's not usual that. I hope you will have time to explore and discover all the city has to offer. Thank you very much for coming to our 6th symposium. I should like to begin with a short introduction to the day. The signatories of 2015 Paris Agreement committed to reducing greenhouse gas emissions. This is why it's necessary to promote sustainable development with low emissions of greenhouse gases. And the energy sector is deeply involved as it generates about 2/3 of world emissions, 40% of which come from the power sector. Could COP21 transform the energy sector? The energy sector is currently facing major challenges due to the transition to a low-carbon energy system and its implications in terms of security of supply, availability, and competitiveness. Coupling these issues involve renewable energies, energy efficiency, flexibility, smart networks, interconnections, and a demand-side approach. In sum, new regulation and new energy policies. This 6th symposium will shed light on the questions raised in the sector about how to face these unprecedented challenges. This meeting will examine various questions related to the flexibility of the system, energy efficiency, policy, and market design. The European Clean Energy Package emphasizes the importance of these questions for the transition to a newly designed energy system. Today, our debate addresses this crucial issue. Smart grids provide flexibility and the capacity to curb new risks. Likewise, the aforementioned challenges require expanding the market scope and providing the system with adequate interconnection capacity, resulting in greater and more efficient competition. Interconnections and cross-border trade are of major relevance for flexible product provision. Furthermore, low-carbon energy systems also require substitution flexibility and access to alternative fuels which are less polluting and cheaper to run. Our second focus is to analyze the role of energy efficiency. Energy efficiency is fundamental. It's fundamental in the reduction of emissions. This should be a priority for households and industrial consumers, and of course, for environmental policy. Market failures, behavior explanations, uncertainty about energy savings, possible energy efficient gaps or rebound effects, and what the best energy policy options are for consumers are central to this debate. Our third subject is policy and market implications. How should we design the functioning of market and the promotion of of low carbon alternatives? What will policies be and what effect will they have on energy policies? The growth of renewables energy makes it possible to achieve environment objectives. But however, the presence of renewables in the spot market has altered the basic criteria of its operation. There has been a displacement of thermal energies, an increase in volatility, extra cost through the subsidies policy, and clear allocative inefficiencies. The challenge for energy policy makers is how to adapt for the necessary increase in renewable energies and reduce or eliminate these negative effects. In this vein, we are going to analyze these points. Price volatility is a relatively new phenomenon for consumers, producers, and electricity retailers, at least from an energy economic analysis. It manifests itself in different ways according to the aversion to risks of the agents. Another problem is the regressive distribution effects and high social cost of the feed-in tariff. Likewise, the level of economic and social development of each milieu requires a concrete and a specific energy tech policy to support renewables. These questions I have raised here will be addressed by the speakers today. The strict selection of speakers presents us with cutting-edge ideas of these topics, and our prestigious chairs will guide the debate and conclusions. At the first table, flexibility for the transition, Luciano Greco analyzes the role of smart grids. Interconnections and cross-border trade will be presented by Jordi Paniagua. Green car adoption and the supply of alternative fuels are the focus of the analysis presented by Julia Pavan. At the second table, energy efficiency. Christian Hughes will present an analysis of the effect of a mandatory information program on energy efficiency. Didi McCoy shows the effects in energy efficiency upgrades in the UK. And for the industrial consumer case, Agustí Segarra Blasco presents an empirical research about the drivers of energy efficiency and renewable energy measures adopted by European small-medium enterprises. The third table deals with policy and market design. Valeria Di Cosmo presents theoretical and applied studies of the relationship between risk-averse consumers, retailers, and producers. The additional implications of mechanisms for financing renewables is presented by Chucky Garcia. Francesco Bona presents an evaluation of the effect of the mix of market-based policies and command and control regulation on renewable energy innovation. Lastly, Baran Dodan focuses on the distributional consequences of alternative carbon emission reduction policies on power producers. Chairs discussants Pablo del Rio, José García Quevedo, and Andreas Loschel will pose the first questions, order the debates, and give us some brief conclusions. Finally, I would like to express my gratitude to keynote speakers, Professors Frank Wolak and Mario Radwitz. Mario will be in charge of the closing session. So, our day begins with one of the greats of energy economics. Let me introduce Professor Frank Wolak. Frank Wolak is the Holbrook Working Professor of Commodity Price Studies in the Department of Economics at Stanford University. His fields of specialization are industrial organization, econometric theory, and energy and environment. His work focuses on methods for introducing competition into infrastructure industries, telecommunications, electricity, water delivery, and postal delivery services, and on assessing the impacts of these competition policies on consumer and producer welfare. He currently directs the program on energy and sustainable development in the Freeman Spogli Institute for International Studies. Professor Wolak has an outstanding record. His numerous publications have appeared in all the top reviews and are key to any understanding of energy economic analysis and new regulation. Yes. Although I'm sure that, fortunately, Professor Wolak doesn't suffer from the academic disease of counting quotes or indices of impact. Let me, Frank, even though you are not interested in that, but let me say that your publications have had an effect of epidemic proportions in academia, because I saw you have around 7,000 citations. As well, in his scientific body of work, Professor Wolak was the chair of the Market Surveillance Committee of the California Independent System Operator for Electricity Supply Industry for 12 years, and also member of the Emissions Market Advisory Committee for California's market for greenhouse gas emission allowances for 2 years. And what is it here? And in 2007, we meet each other, yeah? I had the honor as president of the energy regulator here in Spain to invite you to a conference on energy and regulation. Your lecture, Limitation of the Potential Disadvantage of Electric Competition in the Wholesale Market, is one of the chapters of this book. This book is a part of the bibliographic collection of the Spanish regulator. Thank you, Frank. Thank you very much. And it's a great pleasure for me to present you again. It's your second year, I hope I could think the first. Thank you for accepting the invitation today, this time to give the inaugural presentation at the 6th Symposium on Measuring the Impact of Purely Financial Participants on Wholesale Market and Retail Market performance and proposal for long-term resource adequacy. Thank you, Frank. Thank you very much. The floor is yours.
Thank you. Thank you for that very nice introduction.
I'm going to sit there. In this way, you can do your speech style.
Okay, thank you very much. Is this on? No,
Hear me? How about this? All right, I'll just speak, so we'll be fine. So thank you very much again for the introduction, and thank you for the invitation to present. What I'd like to talk about today is, for those of you who might have been here yesterday, kind of a continuation of some of the issues that we raised there. I think for me, the big thing that I think is underappreciated in many contexts is the increasing importance of purely financial participants in these markets as we move forward with more and more intermittent renewable resources. And the reason being is that, the simple fact of them is there's significantly more risk of supply shortfalls. Those sorts of supply shortfalls can be managed through traditional risk management instruments in forward markets and the like. This is essentially about this issue of both competition policy, but there is also, as I said, this aspect of managing increasing amounts of renewables. The basic challenge is in terms of competition policy, comes from the fact that in many of these markets you have vertically integrated, what at least is in some areas called gentailers, which they own generation assets as well as sell retail electricity. And a big problem is, how do we encourage competition? How do we get more and more market participants in there to make sure that these outcomes are as competitive as possible? And as I talk about, the sort of vertical and horizontal separation are pretty hard. For those of you who would love to see some extremely negative things written about me, feel free to Google my name in New Zealand, and you'll find all sorts of wonderful things relating to some work we did with respect to the New Zealand wholesale market. And again, with this in Australia, is a similar issue of the vertical integration between a large electric retailer, in this case AGL, acquired the largest thermal generator in the Australian state of Victoria. So it's quite difficult on the structural side to do these things. So one question might be is, how do we solve that problem? Another issue is this long-term resource adequacy issue. Is we have this problem of energy shortfalls, not capacity shortfalls, are really the reliability challenge that we face in a world with increasing amount of renewable resources. Capacity markets, as we discussed yesterday, are really poorly suited to address a problem of energy shortfalls. The issue might be is a forward market for energy is really, I think, the way to go. And one of the questions is that, that an anonymous market for standardized contracts allows the entry of purely financial participants. And the way it works is that you purchase this hedge. With this hedge against the spot market, you now have the ability to offer a product that consumers might want, which is essentially a fixed price, or at least a fixed price with some demand responsiveness built in, retail contract. So that's sort of the first part. We get competition on the retail market. The next part is that these forward sales also increase the amount of forward market obligation that the generators have. And one of the things that a lot of the work that I've done is to show that what happens when generating companies have significant amounts of forward contracts. This gives them a unilateral incentive to be more aggressive participants in the short-term market, and therefore lower amounts of market power get exercised. And so what you get is the potential for increasing competition in the retail side, as well as more competitive market outcomes on the wholesale side. And so, a standardized forward contract market might be a way to move forward with a resource adequacy mechanism. The basic point is that we have this kind of missing market problem, in the sense that in the new world, no one really cares about meeting their demand for electricity 2 years from now. That used to be the domain of the regulator and the vertically integrated utility. So maybe having some sort of mechanism where these sorts of forward market has some regulatory rules associated with it that I'll discuss is a minimal way to intervene and yet still serve the market. So the background for this project was basically it came from Singapore. This Singapore Energy Market Authority, their regulator, was concerned about competition issues for good reason. Singapore is a small market. There's 3 firms that own, certainly more than 60% of the capacity. There certainly is clear evidence this is a thermal-based system of unilateral market power in the market. And so one question might be is, what should Singapore do? Structural separation is very difficult. So the idea was to say, why don't we try this for the reasons that we just discussed here, and likely, hopefully that will improve both wholesale and retail competition in Singapore. And one of the nice things about Singapore, which is certainly different from the United States, is if you have a good idea and it makes sense, they do it. So what happened is in April 2015, this market was introduced. The contracts get traded on the Singapore Exchange, and effectively the way that it got implemented in Singapore, and another thing that's advantage of there, is that all of the incumbent generators in Singapore were required to effectively offer bid-ask spreads. Essentially a difference between the price at which they buy power at and the price at which they sell power at. And then this would mean that financial players, other participants could do as you do in any sort of bid-ask market, is to accept that offer to transact, to form a contract. And so the question that we want to look at is this idea, did the introduction of these forward market lead to lower retail prices? Did the introduction lead to wholesale prices? And can we use this as sort of a foundation for a long-term resource adequacy process that will really hopefully address what's coming in terms of increasing amounts of intermittent renewables? So what I'll do is first just give you a little outline on the wholesale market there, talk about the theory that's sort of motivating the empirical analysis we'll do, and then talk about the empirical results and the implications. So Singapore, as discussed yesterday, they run a single settlement, meaning a real-time LMP market, locational marginal pricing market. Generators are paid the LMP their location on a half-hourly basis. There's no capacity payment mechanism. There's payments for energy and ancillary services. And consistent with what we talked about yesterday as well, everybody pays, all the loads pay what's called the USEP, the Uniform Singapore Electricity Price, which is essentially a quantity-weighted average of the LMPs at all the points of withdrawal in Singapore. And there is congestion in Singapore. This is a simple sort of a schematic of their grid. But it's a small island, but still different locations and different levels of congestion. And it's pretty much all natural gas fired. I mean, the Singapore has virtually, obviously, no natural resources on the island, and moreover, they for the most part create islands by taking dirt from Indonesia and putting it in the ocean to essentially make their island even bigger. But so that's about the extent of what they can do to enhance their natural resource base. But everything is imported natural gas. They have an LNG import facility, as I said, and essentially a little bit, as I said, of municipal waste and biomass. So here's just what it looks like in terms of the generation sector. And as you can see, the 3 large firms own roughly 60% of the installed capacity. The thing is, just to notice is remember these names, because when we go to retailers, you'll see that those names are also the big names in retailing as well. But Singapore has a contestable, as they call, retail market. So if you have a average monthly consumption of at least 2,000 kilowatt hours, you're eligible to become contestable, which means you can choose whatever retail supplier you want. There's, as I said, roughly 30,000 of these customers. And the typical pattern of entry into retailing, because the USEP is extremely volatile, is you want to hedge against that very volatile short-term price. And so what you would typically do is construct a generation unit, and that would serve as your physical hedge against the volatile USEP, and then you could then compete and supply retail electricity. And because of just the extreme volatility of these prices, there's very little, you would be not very intelligent to enter and purchase out of the short-term market because your retailing business could be decimated if a period of fairly high prices came through. All right, so as you can see, except for SP Services, which is the default provider, the same guys right here are also the big guys in retailing. So these are the large gentailers, although you can see a little bit of entry of little guys. And the nice thing is that Singapore does have initial conditions that favor the entry of purely financial retailers. One of the big problems that you face is how do you hedge the quantity risk that you have associated with serving a retail customer. If the load shape, say in the day, looks like that, the nice thing is in Singapore, it's just hot all the time. So effectively, load shapes tend to be pretty flat. So a simple sort of a contract, just a flat load shape contract, such as what trades on the Singapore exchange, is pretty good at hedging that risk. And then what you can do is have essentially demand response to help you to manage those deviations. And so, in some ways, this is the ideal environment for the simple sort of forward market to work the way that we'd like. All right, so what's the contract look like? The contracts, as we said, are essentially, they must post bid-ask spreads for minimum volumes. The current spread is 5 Singapore dollars, which is, if you put that into US dollars, it's probably about $3.50. And then, as I said, there's certainly 6 market makers in Singapore, 6 generating units that are providing these services. And the nice thing is that what you would do if you're a purely financial player is you need somebody with essentially the ability to take on a little bit of financial risk. So you might partner with a financial firm, and you then go and get the customers, and you become a retailer by effectively purchasing a futures contract that essentially is over the term that then you will deliver your retail contract so that you have a hedge against the volatility in the USEP during the period that you're delivering under your retail contract. So the way it works is these contracts are essentially quarterly contracts where you're clearing a flat quantity each half hour of the day over the contract length. And that's and as I said, they're offered typically 9 consecutive quarters starting from the fourth quarter. So think of it as you have essentially liquidity for roughly 2 years into the future in these contracts. And you, as the market maker, must offer that bid-ask spread for those various periods so that then potential entrants or others can come in and purchase those. So what is the sort of theory underlying what we're doing? Well, we've got the fact that, as we said, both gentailers and new entrants can buy and sell futures. And as we said, the new entrants apparently use the contracts to compete against the incumbent retailers. So what I might do is I'm interested in serving a contestable customer. I'll go in, and suppose I'm interested in selling that contestable customer for a month. I would then buy 4 quarters worth of contracts for what I think is pretty close to the volume that I'm going to sell in that retail contract. And now I'm able to effectively know the price in the wholesale side at which I'm going to purchase power to compete to sell that retail contract. And virtually all the retail contracts in Singapore tend to be fixed price, fixed duration with monthly quantities of energy that are sold. Small number indexed to LNG prices, but for the most part, the new retailers, as I said, don't compete in that market. So the basic prediction that we think is if we've got a large volume of outstanding contracts that are going to be delivering over some future horizon, in particular the horizon of this retail contract, we'd expect that now the incumbent generators are facing greater competition from these new entrants. If there's a lot of outstanding position, that must mean there's a lot of guys out there that are able to effectively compete against the incumbent generators to supply a retail contract. So we think of a larger volume of outstanding futures contracts over the delivery horizon of the retail contract would predict a lower price for that contract. okay, for that retail contract. All right. So then the other side is on the wholesale side is we think that, okay, generators are selling these futures contracts. These futures contracts are making them have an obligation to effectively sell power at a fixed price, so therefore reducing their incentive to effectively try to push the price up in the short-term market. So we'd say, okay, futures contract sales to the new entrant retailers increases the forward contract obligations of generation owners, reduces their incentive to exercise unilateral market power. So the prediction is the higher quantity of open positions. An open position just says there's a contract where we've got a party that owns one side and a party that is obligated to serve the other side. The open positions that are clearing implies essentially less incentive for the generators to exercise market power. So the simple sort of mathematics behind this is you're a vertically integrated gentailer. You've got retail price, wholesale price, retail quantity that you sell. Then you've got what's my sales in the spot market for my generation units. These are my difference payments associated with the forward contracts that I have. This is the transmission charge that I pay for meeting my retail load. This is not in the most intuitive manner possible to see the incentives. In the next slide, what we can do is translate it into this. And what you can see is that this is pretty much invariant to anything I do. Retail price is fixed, transmission charge fixed, marginal cost fixed. Q retailer, that depends on just what the weather is. This is forward contract price, marginal cost, contract quantity. This term is the only term that impacts my incentives for behavior in the short-term market, because as you can see, it depends upon the spot price, P. So the basic idea is that until I sell more in the short-term market, then my retail load obligations plus my net forward contract obligations, I actually want to keep the price below my marginal cost. Only once I'm able to sell more than this quantity here do I want to push the price up. And so as a consequence, what can happen is if I'm having future market sales by the gentailer is essentially the same as increasing QC by some positive amount delta. And so as you can see, what that's going to do is going to make me more aggressive bidding into the short-term market for a larger quantity of energy. So hopefully what we should expect to see is a larger delta Q out there, or delta out there, the more aggressive these guys are. So the quantity of forward contracts from this standardized market that are clearing in that day is essentially, we think, would predict lower prices. Okay, so how do we investigate these hypotheses? Well, the other nice thing about Singapore is that if you ask for the data, they usually give it to you, and they can get it from market participants. So what they have is essentially for every fixed price contestable retail contract, they collect it. So you know what the price was paid, the start date, the unit, the seller type, whether or not it was sold to by an incumbent gentailer or a new entrant, the duration, how long that retail contract was, the monthly contract volume. The other thing is that you can get data on, we've got data on the open position for all these futures contracts. So in other words, at each type of contract, so remember you guys got 9 quarters into the future of these contracts, we know what's the volume of the open position in that contract, what's the settled price for that contract for all the sample period. So what we can do is we can compute, if you like, the average open position as of the month before the contract, the retail contract starts delivering over the duration of that contract up to 9 quarters into the future. As I said, most of the contracts about, the median is certainly about 12 months. For the most part, few are longer than 24 months, so we're in pretty good shape. So all we're doing is just saying, as of right now, before that retail contract, so most of the retail contracts are being negotiated, auctioned, whatever, in the month before the delivery takes place. Then what happens is we know from the futures data what's the average volume over the term of, say, this is a 1-year contract. So over the term of this 1-year contract, what is the average volume of outstanding position? That's the one thing we compute. The other thing we compute is what's the average price that you paid. So all you're doing is just taking the open quantity and the price paid for that open quantity, and you're taking the quantity weighted average of that as our other as the other variable we're interested in. So then what we do for the retail competition analysis is we have the price that you paid for the contract. So the unit of analysis is contract that you paid, all the contracts for all contestable customers. And if the contract was sold, we know if the contract was sold by an independent or an incumbent. We know the duration, we know the volume. And so one of the things that we wanted to account for as well is how much capacity is just there out there, because we want to control for the fact that if there's a lot of generation capacity out there, we just accept ceteris paribus that you would get a better deal than you would get if capacity was tight, regardless of the level of contracting. So that was a control we wanted to account for. The other is the monthly LNG price, because remember, LNG prices are really always at the margin in terms of the market. And then the next is we just have an indicator for if the contract was signed in the market when the futures market exists. So you could think of it as there's sort of two effects that we want to capture. One is the effect that just says what happens as a result of the existence of this futures market. The other effect we want to look at is what happened as a result of a larger volume of trades, outstanding positions in this market, figuring that if that larger volume is going to predict at the margin marginally lower prices. So what are the and that's basically what I just said there. So higher average weighted price is predicting a higher price for the retail contract. If essentially what I paid to hedge that price risk is higher, the price that I am going to have to get as a retailer is likely to be higher. And then a larger volume outstanding in terms of these futures contracts, we're thinking that that's just saying, look, there's a lot more people out there with contracts to sell. That's going to predict lower prices on the retail side. And then finally, difference between independents and incumbents. We think the effect of this is going to be larger for the incumbents than the independents, because the incumbents, remember, they own generation. The independents, they're just purely financial participants that enter. So what we see, the important thing is just to notice that consistent with what we talked about, you can see that average Q is negative across all the specifications, and in addition, just the entry of the market is also predicted significantly lower prices. Prices are higher if effectively the average price at which you acquired the forward contract's higher. Consistent with this. This is just for, this is for the log specification for the dependent variable, the log of the retail price. And what we can do is just compute counterfactuals to give you some idea of the magnitude of this effect. So think of it as all we're doing is just taking away the impact of the open position from the price and then computing the change in contract revenues. And you can see, for the most part across specifications, these are non-trivial, sizes of the effect in terms of the extent of competition. And, if you don't believe econometrics, there's also plenty of anecdotal evidence, certainly among the incumbent generators. When these financial players started coming in, they found they were losing a lot of contracts, and they then subsequently started bidding significantly more aggressive into a number of the auctions that were held for this, or just in the negotiations they had with the contestable customers. All right, so the wholesale side. So for the wholesale side, we've got the average hourly, we've got the half-hourly uniform system price for all delivery quarters. We know the demand, we've got a demand forecast, we've got natural gas prices to control for essentially the cost to meeting that demand, and we know the quantity of futures contracts settling that day. And again, we want to account for what we think is just the amount of spare capacity out there as a measure of how competitive we think the spot market's going to be. And the idea here is, after controlling for the level of demand, price of natural gas, the cost of meeting that demand, the more futures contracts settling that day should predict a lower USEP price. And what you can see again is open positions predicting a lower price, and then over here in the log specification, same thing, predicting a lower price. And again, you can see, the results are certainly, substantial, particularly for the log specification. So what do we conclude? Well, certainly, as I said, the empirical evidence suggests both on the retail side as well as the wholesale side, by essentially providing this entry vehicle for purely financial participants, what we've done is effectively created a more competitive retail market as well as more competitive wholesale market outcomes. And it certainly, to me, suggests a regulatory benefit to establishing such a market as a mechanism for long-term resource adequacy. And what do I mean by that? As the way to go is the following. So what we could do as an alternate approach to resource adequacy is to say, look, you as a retailer in this market, your, if you like, long-term resource adequacy obligation is you must purchase this standardized contract at various horizons to delivery in certain volumes relative to your realized demand. So what do I mean? So it would work like this, to say, okay, you're going to purchase 100% of, say, your expected demand or your actual demand, depending upon how you'd want to set it up, 1 year in advance, 90% 2 years in advance, 85% 3 years, and say 80% 4 years, whatever. And the regulators, we could think of it as that the contract percentages are the regulator's security blanket. So to the extent that the regulator is a little nervous, may not think there's enough capacity getting built, he or she could increase those percentages that all retailers must purchase. And the nice thing is that there's no capacity requirement. You're just simply saying, I know consumers are now protected. Why do I know consumers are protected? Because you purchased that demand in this market at a fixed price. And the other is that we're letting suppliers figure out the least cost way to meet that demand. We're not specifying a capacity obligation. We're creating a level playing field for demand and supply side solutions. In other words, if you can solve the problem through a demand side solution, you don't probably, you can sell back and essentially take that risk. And as I said, it focuses on the primary reliability problem with the significant amounts of renewables, which is adequate energy to serve demand. One of the big issues that we need in these markets is, if you've got a lot of renewables, is you would like the renewable resource owner that may sell a forward contract for energy to effectively reinsure the quantity risk that it has with meeting that energy through a hedging arrangement with a thermal supplier, or at least a dispatchable supplier of some sort. By effectively creating this obligation on the part of retailers, you now create the demand for this futures product. You then create, hopefully, the demand for this reinsurance product. And the other benefit of it, as I said right here, is the nice thing is that a big problem that's faced, as well as in Singapore, as well as in a number of Latin American countries, is how do I set the default retail price for customers who are still on a regulated tariff? Well, what you can do is you can use essentially the futures prices. So similar to what I did to compute that quantity weighted average price that I entered into my regression, you could effectively say, okay, we're going to take the futures prices that we see as of this date. That is going to be the price at which you regulated retailer must purchase your wholesale power, and if you can do better than that, you keep the money. If you do worse than that, your shareholders will have to make up the difference. So, as I said, the other thing is that these purchases by retailers don't preclude other bilateral contracts, just that the retailers must hold these contracts, and the reason they must hold them is that what we want is this price insurance for a certain price for the retail side of the market. And then the other is there's no requirement the seller of the contract actually produces the electricity sold. But as I said, because producing electricity is the only way to physically hedge this contract, certainly someone is going to produce the electricity. And the idea is simple, that this addresses the issue that oftentimes the thermal generators will always say, I sell a contract, I have to supply the power. No, I'm sorry, you don't. What you will do is you should, as a rational participant, buy from the short-term market when there's substantial amount of this renewable energy, sell from your generation unit when there isn't, and in both cases you'll make a heck of a lot more money than always producing it from your unit. because of the fact that there will be many times, if there's lots of renewables on the system, when the marginal cost of, or the wholesale price will be significantly less than your marginal cost. All right, so that's the basic story that I like to tell is the fact that these financial participants are really an important component of both increasing the competitiveness of the retail market and wholesale market, but also as a mechanism to long-term resource adequacy that hopefully reduces the cost of serving demand, has these features that we think are at least going to achieve a lower cost source of supply relative to the sort of the capacity market paradigm that unfortunately seems to be dominating the discussion, at least in the United States, and not really supplying a solution to the problem that we're going to have as we attempt to scale up the amount of renewables, which is energy shortfalls, not capacity shortfalls. Thank you.
Thank you very much for your splendid, magnificent speech presentation.
Okay.
We are going to see there are questions on the floor. Yes, Professor Borrell, Professor Radwitz. Borrell.
Thank you very much for your presentation. It's been really interesting, and the experience in Singapore, it's really challenging and interesting. No, it's okay? More or less? You hear me? Yeah, okay, wonderful. My question is about the way you present is as if there is this market for hedging, this futures market. The future market, the participants, you were not introducing the strategic decisions first to go to the future market by the participants, particularly the generators or the retailers. So I'm assuming that the assumption underlying that is that there is a competitive market for this hedging, this future contract that is working well, and nobody can project the expectation of the unilateral market power that they may have in that market. So my question is, what happens if this future, this contracting market, this hedging market is not working well? We had experience in Spain with some auctions that were not working well. So the market participants were manipulating that market. So in that case, this hedging mechanism was not avoiding these market participants to exercise this unilateral market power in the future market. How can Singapore avoid that?
It's basically the simplest way to think about it is you've got to have liquidity. So that's the big point. A voluntary market, I completely agree with you. New Zealand set up this the generators set up this futures market, and they essentially trade sham volumes back and forth. And they demonstrate to the regulator that they're doing what the regulator told them to do. That's not going to work. The big issue is that you need essentially significant volumes. You need a mandatory buyer. So, that's why, as I said right here, mandatory purchases. So this is your resource adequacy obligation. The other issue is purchasing in advance. If you're buying a futures contract for next quarter, that's not getting you much of a hedge at all. What you want is essentially purchases far enough in advance so that new entrants can participate in that market. And that's the other thing, because if what you're doing is mandating purchases, a month in advance, a quarter in advance, even almost a year in advance, it's only going to come from existing participants. The purpose is to try to bring more firms into that market, and that's why it really is, as you saw here, this is the area where you really do need if you like, regulatory assistance, in that that mandate is what's going to get the new capacity built. That mandate is what's going to be competitive. They sort of all work in stair step off of one another. But I will be completely. I want to make it completely clear that you do need a regulatory mandate. If you don't have a regulatory mandate, you're likely to be in that situation. Or the other way you can do it is the more of the Australian solution, which is you can say the price cap on the short-term market is $13,000. $13,000 per megawatt hour tends to focus the attention. Whereas if you don't, you're going to need much more of a mandate that says to the retail loads, you must buy this. If you don't buy this, you will be subject to penalties or other kinds of things. But that's what you're trying to do, is create liquidity for this product that is going to finance the new investment, that is going to because of the obvious problem. If you don't have a demand, you're not going to have a supply.
Thank you. Professor Ragwitz? Here, first round. Here.
Thanks for it's a very interesting presentation. You started off by saying that the beauty of Singapore is that you get things realized when you propose, compared
Only
to
if it makes sense.
if they make sense, opposed to other countries. And of course, we have the capacity market discussion in many other countries, in Europe, in the US. And I wonder whether it's just the inertia in these countries which makes it difficult to install such a system, or whether there are also other aspects. And like one of the issues on capacity markets, on fears of capacity markets, is that we end up with overcapacity and in a sense of an inefficient market. How big is the risk to end up with overcapacity in such a system? That would be one question. And did you look at the dependence of the wholesale, like the day-ahead market, with the future prices in such a system? Does it have implications on the day-ahead prices?
Yeah, I mean, to me, that's the big advantage of an energy contracting approach, is if you say, I purchased the energy in advance, you're basically telling the market, figure out the least cost mix to do it. And you're not saying how much capacity you need. In a capacity market, the standard argument always is there's a missing money problem. My interpretation of the missing money problem is that because you set the capacity requirement, precisely the dynamic you're talking about occurs, is that you get very low wholesale prices, which then everybody says, oh, you need a higher capacity payment because there's missing money, because there's low wholesale prices, because you've got excess capacity caused by the capacity market. So, it's, you missed my rant about capacity markets yesterday, but it is, to me, I think that there's no way that we are going to get the benefits from restructuring if we have capacity markets, simply because it evolves into a very inefficient cost of service. Because, for example, all the, quote, capacity markets in the US are purely capacity markets in name. What they do, just to give you the sort of worst part about it, is that existing generators can't bid into the market, and moreover, there's no demand in the market that any market participant puts in. It's a regulatory demand, which I call the DEMAN curve, to distinguish it from a demand curve. So it's just because the demand curve is the willingness of consumers to pay, this is the administrative rules that are causing to get paid. So yeah, I mean, I think this is it. The big problem with this is you have to believe in incentives. And engineers do not believe in incentives, in my experience. They believe in, I control it, I've got it, and I can do what I want with it. And so hopefully we'll evolve to one where it is that these, the incentives dominate. But I think it's largely, I think it is in part in Singapore. I mean, come on, they believe in markets like you wouldn't believe. So they're okay with the fact that there is, this sort of thing.
Thank you, Fran. Mr. Junta, here.
Thank you very much for your very good presentation. I don't know.
You can present, he came from the
Yes.
regulatory authority.
Oh, thank you.
Okay.
Thank you very much. Well, it was a very nice presentation indeed. Yes, I have understood that according to your presentation, if you establish certain mandatory purchase through long-term market obligation, in particular market makers and so on, it's a very good thing for competition, and this has been applied in Singapore market in electricity. But I am wondering if something similar has been applied into the gas market, because Singapore has a certain similarities with the Spanish gas market, in particular the dependency of the LNG. Something similar could be established, or what is your experience in the gas market there? Thank you.
Most everything on the gas side in Singapore is pretty much on these long-term contracts. They through the SLNG, the sling, I guess, let's see if I can find it. But I mean, the big problem that they have, and it's starting to loosen up, is that most of their purchases were effectively done through long-term contracts to get the LNG facility built. The generators purchased those long-term contracts. More and more, there is de-leaking, as I'm sure you know, from most of their contracts were linked to the price of oil. De-linking is starting to occur as a result of the shale gas revolution in the United States. The other thing that's happening is essentially you're getting similar to what happened with oil tankers, is you're literally having LNG tankers that are going to the highest priced place now, which is so. I guess I'd argue it's pretty much all good news in terms of the LNG side, because of the fact that there is a lot of LNG tankers out there, and the Singaporeans they had some costs associated with their contracts, but it is. I hate the pun, a very liquid market for liquefied natural gas, so at least at the moment for them. So, but you know, that's certainly one of the reasons that that the risks that the generators face is the price of LNG.
Sí, a ver, al final no sé cómo se llama después. No, Pedro, hay otro antes que tú, perdona. Disculpa. Si se pueden presentar, si no los presento yo, por favor.
Thank you very much. Joe Perkins from Ofgem, the UK energy regulator. Yeah. Really interesting setup, and yeah, looks very relevant to Singapore. I suppose my worry was about how intermittent generation could fit into this sort of setup. You know, I was thinking that if I owned a big wind farm, that I might feel reluctant to sell forwards contracts because I just wouldn't know, or wouldn't feel I had much confidence about whether I would be able to produce on a particular date, 6 months, 9 months in the future. And obviously that's a very big issue for lots of countries, the UK included.
Yeah, my response to that is, you sell energy, get with it. I'm really sorry, but generators have outages, you have outages too, manage that risk. There's a whole chapter in this report that we wrote that sort of talks about the idea, but the simple way would be is, the first step we have to do is get rid of essentially all quantity risk associated with the renewables goes to load. That's a subsidy. I mean, pure and simple, I'd argue that's a subsidy. Is that you need to play with the big boys, and the big boys sign fixed price, fixed quantity contracts, right? And so you need to figure out how to hedge that quantity risk. To hedge that quantity risk, you're going to need to buy reinsurance from the thermal supplier. Go out and buy it and charge a higher price for the contract, factoring in the risk that you have to purchase the replacement power. I realize that's fine for me to say right now, but that's where it's got to go. At least I think of it. And the nice thing is in the case of Colombia, the argument I got made was the opposite argument that you made, which was all the thermal guys go, well, we sell a contract and we sit on the sideline for 3 years. And my argument is, no, you should be signing a forward contract for energy, bid your unit in at marginal cost, and every hour you will be making the efficient make-buy decision for the quantity of energy that you've sold. And that's what we want, because one of the things that happened in Colombia, for those of you who might be familiar, is they had this wonderful capacity payment scheme in place. One of the large thermal generators collected his capacity payment for 4 or 5 years, and then when the El Nino event came, he went to the government and he said, here's the plant, you run it, and all the money that they got in their capacity payment was no longer in the country. And so that did not work so well. So that's another argument against the capacity payment in these sorts of hydro-dominated systems.
Thank you, Fran. There are the two last questions. Pedro Mejia.
Okay, thank you very much. Thank you very much for the presentation. A couple of my questions have already been answered. Just to begin with, regarding to the comment made on the Spanish case, I have to say that incumbents were not incentivized or suggested to participate. On the contrary, they had a lot of incentives not to participate. Because when you allow for the participation of people that don't live in the country, you are open the supply for many more participants to be within that market. Just to begin with, so there is a big difference between the Spanish case and the one, in my view, you are suggesting or presenting. My second question.
What's the difference?
The difference is that in the Spanish case, incumbents were not obliged to participate.
Oh, yes,
So
no,
on the
I agree. But as I said,
on the contrary,
you have to
they had a lot of incentives not to participate.
Who wants to spoil the party?
I didn't know that an Ofgem representative was here. It is my understanding that in the United Kingdom there is something similar to this approach, because it is true that the big six are obliged to make an offer in the futures market with a defined spread. And in that case, do you know if there is any empirical evidence about the results of this model? And my final question was, you mentioned that Colombia, perhaps the CREG, the Colombian regulator and the power exchange, XM, were considering to introduce this system that is instead of the PEM model that they now have, or beside that model, because it's very clear that the Colombia system failed 2 years ago.
I'm glad. I hope you keep telling them that.
Yeah. And at the same time, the PEM model also failed 3 years ago. So
the which model?
The PEM.
What's the
PEM in Philadelphia.
GPM.
The PEM 3 or 4 years ago, the system worked, but there was a big blackout because gas was unable to get the plants. So people received the money that had gone to the auction and received the money, but when the time came, they were unable to deliver the energy they were paid for.
Yeah, we call that in the United States the sick day problem. But yeah, or the dog ate my homework. But yes, it's very difficult to. So it's at least my view is it's trust and verify. In that what you want to do is if you sign a contract, then you bear the full cost of your failure to deliver on the contract, and that is the best incentive to ensure that people do honor the contracts. But I completely agree with you that the big issue is, and the approach that I think works better, is to mandate a demand rather than to mandate a bid-ask spread. Because simply mandating a bid-ask spread, unless there's enough risk of not contracting, you may not get contracting. But if you're mandating a demand, so in the sense of here, where I'm saying here, that retailers, this is part of your long-term resource adequacy obligation, I think that creates the demand. And the big issue is that, as I said, where I think the market needs help is in the out years to effectively get competition for the sort of out year supply of energy to get the new capacity built. And that's sort of, I'd argue in the language of economics, the missing market. The missing market is a forward market 2 to 4 years in advance, which I think if you do not believe that market is competitive, don't restructure. But that I think is a competitive market, because anybody that wants to can likely come in, build a new plant, bring it online in 2 to 4 years. And that's what you're trying to incent with these kinds of products, to give them the revenue stream necessary to do it.
Thanks, Frank. Well, the presentation from Wolak, it's very, very interesting. There are a lot of questions on the floor, but we have the commitment to follow with the timetable, the schedule of the program. And of course, I'm sorry, we are going to pass to the next table. And in any case, we will need to reduce the time of coffee break and a little the lunch in order to recuperate our schedule. Thank you very much. Thank you, Frank.